If you want to trade with the institutions, mastering supply and demand and understanding order flow is what's going to get you there. So in this video, I'm going to break down exactly why price really moves, how to spot institutional footprints on the chart, and how I personally identify, mark, and trade supply and demand zones every single day. Now, a lot of people think the market goes up because there are more buyers than sellers, or the market goes down because there are more sellers than buyers, but that is not true. There has to be a buyer for every seller and vice versa. So what actually moves the markets is the balance or imbalance between aggressive orders and passive orders. Now, most of you know there are two types of orders, but for price to actually move, there has to be a real-time flow of buy and sell orders of each type, and this is what we call order flow. Now, the first order type is a limit order. These are passive players waiting to be filled at their desired price. So looking at Bookmap here, you can see the order book to the right. All of these numbers stacked on each level are passive limit orders, but without aggressive traders, the market wouldn't move. And this is where market orders come into play. Aggressive buyers and sellers want to be filled immediately at the best available price, but for price to move, an aggressive order has to be matched with a passive order. Now, if there aren't enough passive orders, price has to walk the book. It's going to jump up to the next available price until the aggressive order is completely filled. So here's an example. Let's say an institution wants to buy 1,000 contracts immediately at the best available price, market value. At the current price, maybe there are only 105 contracts available. So those get filled instantly, but the remaining 895 contracts still need to be filled. Price is going to walk the book up level by level, consuming all the available offers until that full 1,000 contract order is filled. And that imbalance is what causes those sharp moves up and down that we see on our chart. And this is why it matters. Institutions cannot place an order this big and hide it. Their size leaves footprints. And if we can recognize where they've been active, we can position ourselves to trade with them instead of against them. And supply and demand zones are the footprints that they leave behind. So now that you know why these zones actually form, let's talk about how to spot and mark them on a chart, because institutions often defend these areas or finish filling uncompleted orders when price gets back to these areas. So on the chart, this is what you want to look for: an area of consolidation or a base, and then a strong and balanced candle moving away from that base. Now for a supply zone, this is where aggressive sellers stepped in and overwhelmed buyers, driving price down. And so supply zones are going to be found above the current price. And for a demand zone, this is where aggressive buyers stepped in and overwhelmed sellers, pushing price higher. And demand zones are usually found below the current price. Now, I personally focus on marking zones on the 30-minute to the 4-hour time frame. And this is because zones on higher time frames typically see stronger reactions and last longer. And this is because higher time frames capture larger moves, meaning bigger institutional orders were placed at those levels, and when price returns, it's more likely to react. So my process is a top-down analysis, meaning I usually start on the 4-hour and refine my levels all the way down to the 30-minute. But just to keep things simple, let's look at an example on the 30-minute chart. So to mark the zone, I'm actually going to be looking for the candle immediately before the imbalance move. This is usually going to be a small basing candle of the opposite color. So for a demand zone, a small red candle right before a strong green imbalance candle, I'm going to mark that from the open to the low. And for a supply zone, a small green candle right before a strong red imbalance candle. I'm going to mark this from the open to the high. Now, once I mark my zones and price comes back, I'm not going to just be blindly entering. I want to wait for confirmation using price action and volume analysis. So for example, if price is returning back to a demand zone, I want to see buyers step in aggressively here. And if price is returning back up to a supply zone, I want to see sellers step in. This is what's going to actually give me the confirmation to take the trade, not just seeing price come tap into the zone. And you can actually refine your entries even more by using tools like Bookmap so that you can see exactly where buyers and sellers are sitting at. And I'm going to cover this in another video, so don't forget to turn on notifications and subscribe so that you can be notified. But let's go through a live example. So we can see this small green basing candle followed by a strong imbalance candle moving away. And that tells me that an institution probably stepped in here. So I'm going to mark this area from open to high as a supply zone. Now, when price comes back into the zone, I want to watch how volume is reacting as it moves up. And in this case, we can see that buyers started to weaken, and as soon as we tapped into the zone, sellers stepped in. This to me is a sign that this could be a solid entry point. So for me, I'm gonna go ahead and scale down to a lower time frame, like the 5 minute, 1 minute, or even the 15 second to refine my entry. Now in this case, I'll stay on the 5 minute, and I usually like to look for, some level of support or resistance, or a trend line break, or some sort of other confirmation for entry. But you can see here we have this 5 minute support that I can use as an entry for this trade. Now at this point, I'll just set my stop above the key level that I used to enter at and target the next level of liquidity below. That could be prior high, prior low, level of support or resistance, or some level of liquidity that we see in the order book. But in this case, I'm just gonna use this area of imbalance as a first TP. And remember, you can use this concept as a scalper, as an intraday trader, or even a swing trader. And so if I wasn't scalping this, I would go up and move to maybe the 15 minute like this, and I would still look for that confirmation. So in this example, we can see we have this double top form after rejecting the zone twice. And we now have this 15-minute support here that I could use as an entry for the reversal down, targeting my next key area. Now later on, I'm gonna teach you how to refine your entries even further by using tools like Bookmap or Depth of Market so that you can see exactly where buyers and sellers are at. So if you're interested, or if you enjoyed this video, don't forget to turn on post notifications and subscribe so that you can see it. And if you're interested in joining my day trading community where you get access to my levels every day, educational calls, access to all my courses, don't forget to click the link below and be on the lookout for some big announcements coming soon. But if you enjoyed this video, don't forget to like, comment, and subscribe, and I will see you guys in the next video.